In the spring of 2021, during the surge of retail trading fueled by stimulus checks and social media enthusiasm, Daniel believed he had found his breakthrough stock. It was a fast-growing technology company with bold projections and headlines promising disruption. The charts were rising sharply. Analysts were optimistic. Friends were buying. Daniel invested £8,000, nearly a third of his savings. For a few weeks, everything validated his decision. The stock climbed 15%, and Daniel felt not just wealthier, but smarter. The gain wasn't just financial, it was emotional. He began to imagine what doubling his money would mean: paying off debt, traveling, proving to himself that he understood the market. Then the trend reversed. Quarterly earnings missed expectations. Growth slowed. The price dipped 10%, then 25%. Analysts revised forecasts downward. Competitors entered the space. The data that once confirmed his optimism now pointed to rising risk. Rationally, the case had changed. Emotionally, it had not. Daniel refused to sell. This is the power of loss aversion, a principle identified by behavioral economists showing that the pain of losing money feels roughly twice as powerful as the pleasure of gaining it. Selling would not merely reduce his portfolio, it would confirm that he had been wrong. The unrealized loss felt temporary. Selling would make it real. Weeks turned into months. The stock fell 60% from his entry price. Instead of reassessing, Daniel averaged down, investing more to lower his cost basis. He told himself he was being strategic. In reality, he was trapped in the sunk cost fallacy, the tendency to continue investing in a losing position because of the resources already committed. The £8,000 was gone the moment the market repriced the stock. Whether he sold or held, that capital was no longer intact. Yet psychologically, abandoning the position felt like abandoning hope itself. Eventually, Daniel sold, after the company announced a major restructuring. By then, his losses were significant. The financial damage was painful, but the deeper lesson was more valuable. Markets do not reward emotional loyalty. Investing demands forward-looking decisions. The only question that matters is whether you would buy the stock today at its current price based on current information. If the answer is no, holding it simply because of past investment is not strategy, it is psychology. Understanding loss aversion and the sunk cost fallacy does not eliminate them, but awareness creates distance between impulse and action. In markets, that distance can mean the difference between discipline and regret.